I'm Charlotte McLeod with investinnews.com, and here today with me is private investor Don Hansen at PDAC. Good to see you.
Yes, thank you. Delighted to be here. It's been great.
Always happy to have you here, and I know that our audience is going to be excited to see you as well. And maybe we'll begin. It's kind of an interesting story how we decided to do this interview, because we at first we're planning on it right now.
Correct. Totally spontaneous. Yes. Just from our interactions of yesterday afternoon and last evening and so on. And I'm really excited to do a spontaneous one where we just start to talk about the things of it. I thought it would be interesting to explain to the audience, how did it happen that we decided to do this? Because it resulted from the fact that I realized that a question you asked me yesterday when I went back to my hotel and had a 1 hour rest, and I realized that what I told you was wrong. And so I thought, I have to talk to her about that and correct myself. And then we were lucky enough to meet at the party last night at the Pure Point uranium thing. So anyhow, the issue that you asked me about was what impact the U.S. election had on all the things that we've been talking about, the gold price, the stock market, all that sort of stuff. And my answer was it didn't have any. And that's when I went back and thought about that, and I'm saying, that's not right. That I've missed something big there, and we need to discuss that. But I also might want to explain why I reacted that way. If you remember, in previous interviews, I had collected the U.S. money supply data versus time over 50 years, and there was a data point every 5 years, and you connected the dots. It made a perfect exponential curve, very smooth, and I'm thinking, well, all sorts of stuff happened in between there, but yet it was still steady, so I guess it doesn't matter. And the debt held hands with the money supply and went right up, right alongside of it as well. And so I think, there's something going on here that doesn't seem to care about that. But I think what I'm missing is the fact that those data points were 5 years apart, but that there's a lot of things going on, particularly because in the U.S., our system is different than Canada and Europe, whatever. We don't have a parliamentary system. We have an election cycle that goes 4 years. And so everything is built around that. And the other thing that I realize, I'm a great fan of Warren Buffett and Charlie Munger, and there's a great quotation that everybody quotes of Charlie Munger, who's now deceased in his late 90s. But he said when somebody asked him to explain what was going to happen in a particular situation, and his answer always was, tell me what the incentives are, and I'll tell you what the answer is. So in politics, what is the incentive? What is the primary thing that the politicians care about? It's to get reelected.
Exactly. Yeah.
Okay. So here you have a system that it has a 4-year pattern to it, and you want, if you get reelected, for the good news to happen in the election year, right? Which means if you are going to have any bad news, you want it to happen in the first year. Exactly. So then I went back and looked at political history. Let's see. Reagan was elected in 1980, so first year, 81. And there's a change of political party, a new person. That was a terrible year. I was in the manufacturing business. We nearly went broke because it was a really bad year. Stock market went down and all this stuff. So you had that example. Then in 2000, we went from Clinton to Bush. 2001, we had the dot-com crash, and it was a really bad year. Then we get to the GFC, 2009, we go from Bush to Obama. 2009 was terrible. Then we get to 2021, and that doesn't happen. But I know the answer, because the Biden administration did something that nobody has ever done before in the U.S. If you go and add up the government spending annually from 2016, 17, 18, 19, divide by 4, you get 4.1 trillion average per year. And it didn't vary enormously up and down, okay? And then you look at 2020, 21, 22, 23, divide by 4, you get 6.5 trillion. 57% of an increase that stayed up that high for 4 years and without a war. So you see what that administration did was they basically prevented a recession by increasing government spending astronomically. The whole GDP system isn't set up to deal with that. And if you know how to calculate GDP, which I looked up, of course, 60% is consumer spending, 17% is business investment, 18% is government spending. So here you have an administration that goosed government spending 57% for 4 years, and a lot of the money that the government spent gets spent by consumers. So is it any wonder that we never had any negative growth deals in GDP, and therefore we didn't have a recession? Everything was wonderful, right? Well, of course, that's nonsense. It was all created, and of course, we then grew our national debt astronomically because that money didn't produce anything. So now it's 37 trillion, and it's unsustainable. But I missed that issue because, you see, the thing is now we're in another turnover with a new administration from a different party, and here we in this 2025. Are we going to have the same thing happen? Absolutely, because you have an unsustainable debt. You can't keep doing that, but you're really not going to be able to back it off very much for a combination of reasons, which I'll explain. But it told me that, and then you look and see what Trump is doing. He's trying to clean everything up. They're going to have layoffs. They're going to have the terror, all that stuff he wants to do right now. So that in 4 more years, his political movement, which isn't really Republican anymore, by the way, that election was not about Republicans and Democrats. It was about establishment and anti-establishment. That's something a lot of people in the U.S. haven't figured out yet. But in order to sustain what he's created, he needs for the really bad news to be over with in 3 or 4 years. So, and in 2026, when you have congressional elections again, even if he loses the Congress, it won't matter. If he does something they want, but he doesn't, he'll just veto it. So, you can have a 2-year period where basically nothing happens, but he won't care because he did everything he wanted to do the first 2 years, because that's what they always do. And that's why the election mattered. And that's why I had to correct myself as I'm thinking about this thing. I told Charlotte wrong. That ain't the way it works. It's not going to happen. So I think the probability of us having a recession in the U.S. in 2025, I used to think was maybe 25 or 30%. Now it's 75 or 80%, maybe 90. Because the other thing is that the U.S. stock market is so extremely overvalued based on things like the Shiller PE, which is very famous, and the PE is like 35 or something, which is normally 21 or 2. And 40% of the value of the S&P 500 is on 10 names. 10 names. And the U.S. stock market, those indexes that are now the way people invest in the States most often, it being so-called passive investing, when those indexes take your money, they're going to put 40% of it in those 10 companies. That's what market capitalization weighting means. A lot of people who are investing passively don't understand that causes those big companies to get yet bigger and bigger at an exponential rate. And that's going to mean when it goes backwards, it's going to be accelerated on the downside for the same reason it got accelerated on the upside. But most investors don't know that. They don't understand that was one of the consequences of being into passive. Well, you just buy the market and it'll always go up and everything. But the other one that I would like about my slide number 5, if you'll remember, where it showed where there's a perfect inverse correlation between gold and the stock market, where the stock market's in a bull, gold's in a bear, and then they would invert back and forth. And they've done that routine several times, and we're about to revert again. And so, yes, the stock market's going to go down because it's overvalued, and gold is already going up. And that's an interesting one, because the last time we saw that in 2000, the stock market went down and it took several years for gold to go up. So they don't happen to switch at the same time. But in that particular case, it was a significant delay. Oh, but I already know the reason. If you remember what the central bank buying and selling looked like, okay? So during that time, the central banks were still selling. So you didn't have a tailwind on gold. Now you do, and that's why the gold went up first before the stock market went down. Okay, so I think it's pretty straightforward why that's happening that way. So that's what I wanted to tell you.
Yeah, that's so good. And I appreciate you coming back and, taking some time to think, come back and tell me your new thoughts. And because it does, as always, it makes sense very logically when you lay it out all together. And so also part of our conversation, because I think everybody always wants you to come back and tell them more and more. We had said before, the interview we did in November in New Orleans was something that everybody should probably return to. So I'll have the link to that.
Yes.
So people can go visit it. But just on the gold and precious metals side, is there anything that you would want to leave people with? Just little pieces of anything that you would want people to know right now?
Okay. I don't think there's any question that we're going to continue to see gold going up, because the money supply growth is still going on, and we're not going to be able to change that. That's in the cards. The other thing that I think is interesting to me, I invest in silver too, but not as much as gold. And one of the patterns that I've noticed is they say, well, in a bull market for gold, silver overperforms, but not until the last 15%. And then it goes way up, and then it stays there for 6 months, and then it goes back down again, because of the nature of silver and the fact that 70% of it comes from byproducts. And the concern about silver's supply is that we're doing the electrification deal, right? So we need a lot of copper. Guess where most of the silver comes from? It's a byproduct of copper production. So how's the silver going to go? I don't know. I believe in silver, and I think that it will do okay. But the reason why I'm over invested in the gold sector is that it is truly monetary, and the supply is what it is. It goes up maybe 1% a year or less, whereas silver is all over the place. And you have another. So I like silver, and I like particular silver companies, but just a few. And the ones that I like have a byproduct only of gold. I'm not interested in investing in zinc and lead.
Yes.
Yeah. So and there's 4 that I like. One of them is pure silver. The other 3 is the byproduct of gold. That's just fine with me. I'm good with that. But the other thing I wanted to share about my own investing philosophy is that I've realized over my 23 years of investing in the sector is that I haven't had much success in explorers. And I've talked about this in the past, but the idea of making investment decisions, which is decisions that incorporate risk, is to know how to incorporate that in your evaluation and calculation of what kind of return I can expect. And that's the expected value. And if you remember that, I want to repeat that because it's so important, and so many people don't think about it this way, but it's absolutely, but if most people understood that, they would never buy a lottery ticket and they would never go into a casino, because the probability of them winning is really bad. That's why these casinos have palaces. Well, they got that from your monies, honey. Okay, so let's do an example just to illustrate the concept. We can say that there's an explorer that you really like, looks good, good location, some pretty good grade, da-da-da-da-da-da. And you think, I could make 20 times my money in that, okay? But what's the probability of it actually achieving that because of all the time that it takes and all the rest of it? Maybe 5%, and that's probably generous. People like Rick Rule say it's maybe 3%. So the expected value concept is take what you expect and multiply that times the probability. So that would be 20 times 0.05. That gives you 1.0, right? Okay. But why I'm attracted to what I am now is practicing what I preach and saying, okay, there's a lot of gold producers now that are making a lot of money. And nobody's figured that out yet. But the thing is, there are some who actually have an exploration and development story under their umbrella, that when they bring that online, they will increase their production by 2, 3, 4 times. And they don't have permitting problems. They don't have the financing problems. They don't have the infrastructure problems. They don't have all this other stuff that goes sideways, plus being stuck in the valley of the Lassonde curve. And I always like to talk, whenever I talk about an explorer developers, show me what the Lassonde curve for your company looks like. Because I like to see pictures. And the thing is, with the kind I'm talking about, there's no valley. Because they're producing successfully, so there isn't any valley. And that's where you get stuck. That's where you get in the valley, and then it takes them longer to get the permits. It takes them longer to get the financing. Pretty soon they've diluted you to oblivion. And so they did hit it, but by the time they did, the share prices ballooned, and you didn't make any money. So you need to think about it so that, like if I'm saying that a company like I'm suggesting could easily do 6 times my money, because they're probably going to triple their gross margin because of the increase in production, and the multiples on earnings is going to go up because it's depressed now, and the gold price is going to go up. So I could easily see 6 times. And yet the probability of that happening is like 60%, 70%. That's probably conservative. Well, if it was 60%, that's 0.6 times 6. That's an expected value of 3.6 compared to 1.0. Is that a hard choice then? Well, no, but there aren't a lot of companies like that. I searched this place because most everybody out there is explorers. I mean, 80% at least, explorers and developers. There are not that many producing. A lot of them don't even show, and some of them that I like. But I have 4 companies that I really like that are going to do extremely well, and they don't have any value of a valley of the Lassonde curve to get stuck in. So I'll tell you the names.
Please do, yeah.
Okay, so let's talk about them. One of them is called K92 Mining. It has a project that they think they're producing 150,000 ounces a year of gold now. Deposits in Papua New Guinea. A lot of people, oh my God, it must be awful. It used to be part of Australia. It's English speaking, 90% Christian, wonderful place, and there's lots of gold mining there. And when they get through expanding in the next few years, they'll be producing 450,000 ounces a year. And yet their multiple on gross margin is low. It's like 2.5 compared to Alamos, which is my standard. If I compare everything, theirs is 7.6. In a normal market for stock price, mining stocks, it would be 10 to 12. So we know that the multiples are really depressed. So you look at all that and say, K92 has gotten and checks all the boxes. I really like that one. Another one is called GMINING Ventures, relatively new company. It has a great project in Brazil, and also is going to grow into its resources, and but an extraordinary management team. This company is called G because there's a French family, Gagne. I don't know how to pronounce French things very well, but anyway, the thing is that they have another company called G Mining Services, and what that company has been doing is building big mines for big mining companies. That's their business. So when they decide, gee, I think we'll go into the mining business for ourselves, that's when they started to do that. And the market loves them because these guys are going to come in on time and on budget because they know how to do that. They've been doing it for decades. And so that one again, and AK92, G Mining, low all sustaining costs, all checks all the boxes. And they, again, have this exploration development under their umbrella. And then another one is Aris Mining, that's a similar situation. Not quite as attractive. They have a little bit more debt and not as low a cost. And so I'm not as heavily invested in that one, but the management is extraordinary in that the two men who are the driving force and the primary shareholders, one of them is Ian Telfer of the Goldcorp fame, who built that one. Another one is Neil Woodyer, who's another legend in the mining industry. And those two are doing it. Well, they aren't going to have any problem with money. They're probably both billionaires, as far as I would. Soon, Ian Telfer certainly would be. Okay. And they're in their early 80s, but I'm 84 and I'm still making it. So I think they're probably going to do all right. Yeah, but they're not as quite as attractive as the first two. And then there's a fourth one that I like, and it is not quite in production yet. So it sort of deviates, but it really doesn't. And I like it for a number of reasons, one of which that in previous 4 or 5 years when I wasn't making money on anything, that management team made me money in a company called Rio Alto that was in Peru, I think, or Colombia. I can't remember which. But anyway, that's been 5 years ago, maybe. So I really was appealed to the management man named Alex Black, and he acquired a property in Chile, and it's 5 million ounces, open pit oxide. It checked all the boxes, and I bought into it like 4 years ago. The only thing that happened was that he got into permitting hell when the government in Chile went socialist, and he got stuck for a year. But now that's all changed, and he's financed. He's got everything going, and it's an absolutely great project, and it has big scale-up potential. It's going to produce 90,000 ounces initially, but it can potentially, as he builds that, to go to 250, and it will be in production either late this year, early next year. But it's open pit, heap leach, good grade, all of the things. So there's a lot less risk in the open pit heap leach projects, and a lot less capex for them than underground, and all the issues with that. And this guy is a great manager. So those are the four that I like the best. But the most interesting one right now actually is Rio 2, because they're going to be actually in production sooner, and yet their multiple is lower than the other three because they're smaller, and they had a problem. And interesting enough, I've been talking about permitting. I've had 2 other investments in the mining sector that weren't in production yet, that also ended up over the last couple of years in permitting hell. So I'm one of them was in Nova Scotia, another one was in Mexico. So this is the problem with the exploration and development. This is how the valley of the Lassonde curve, you get basically stuck in it if you have financing or permitting or these kind of problems. It's difficult. So that's where my focus is, in actually switching to these companies where I'm managing my risk. And I really encourage more people to look at it that way, because most people don't. And so if you do that, it'll affect the way you allocate your money, so you'll do better.
Well, thank you so much. And I love how you explain the numbers, because I'm not such a numbers person, and the way you outline it always makes it so even I can understand it. So I always appreciate that. This was really good. I will still encourage everybody to go back and watch that other very extensive interview.
Please do, because then it had all of the data that you really needed to know. I had pulled into that particular interview. It was like all the previous 8 sort of came together with that. But things are still changing, and this is going to be a very, very dynamic year. There's no question about it. And as you're probably familiar with the Fourth Turning book, okay, as Strauss and Howe said, we were going to be in one now, and we are. And so that's why 2025 is going to be such an eventful year. So many things are going to happen. But a lot of times people ask me, well, okay, Don, you're going to have all this stuff. Is it going to go on forever? Well, of course not. And that's because Ludwig Mises says the eventual outcome of every fiat monetary system is a crack-up boom. And that crack-up comes when the debt level is unsustainable. And that's where we are. So all the things point to that. And of course, now the U.S. government is having to roll over a lot of debt because it was maturing. Of course, it was doing that because the Biden administration couldn't sell debt treasuries to the central banks. The amount of the dollar value of the holdings of central banks of U.S. treasuries is the same last year, 2024, than it was in 2014. What did they do? They bought gold with their excess dollars instead of U.S. treasuries. So now, who's buying the U.S. treasuries? It's very interesting. There's 3 foreign buyers. And you won't believe who the names. The first one is London, okay? Not that many people in the UK. Who's hiding money there? Oh, then the second one is Liechtenstein. Okay? Then the third one is even more remote, Cayman Islands.
Right.
So, the Treasury's having a hard time finding buyers for this stuff.
Clearly, yeah.
And the predicament that the U.S. government has is they need the interest rate to be higher in order to attract buyers, except the government can't afford higher interest rates because they can't pay the interest expense. And this is all magnified by the elephant in the room, which is the population deal, the domestic. I'm trying to think of the right word. When in fact the distribution of ages, demographic shift, the demographic shift. Okay, well, that's never happened before. So that adds an enormous complication to this whole predicament about the fact that the monetary system has led us into this huge buildup of debt that now, how can we service that? And yet we can't afford to have a rate. So that means that the government is going to have to do extraordinary means. But this is Mises crack up boom thing, okay? And so how that's going to sort out and the timing, we don't know exactly, but I think a probability of it shaking loose is probably this year. And I know you interviewed Rick Rule a number of times. One of his favorite sayings was something that's inevitable is not necessarily imminent. But because I'm into probabilities, I can say, yeah, Rick, it might, I don't know when, except that the likelihood of sooner has just gone up a bunch because of the administration that's now in Washington, because what they're doing is going to force all of those things to come into a big, what are we going to do now? And none of the things that we do is going to turn out nice. The difference between a predicament and a problem, problems have solutions. Predicaments have nothing, no outcomes that are nice. And we're unfortunately in one of those periods. So how do we take care and look after ourselves? By gold and the gold miners.
Well, we can full circle there, as we often do. So I think that was really good. I so appreciate the update. We can wrap up here, and I'll send you back out onto the show floor at PDAC. I know there's still time. There's still time to take a look at some of the companies.
I have looked to find the special type. There are just not very many.
Yeah. But
that's okay. That's okay, because the reason Warren Buffett was so successful is that he didn't believe in diversification. He would find something that fit exactly what he wanted, and then he would go all in. Or in many cases, he bought the whole company, which he did. In many cases, that's an insurance business and See's Candy and I don't know how many others that he would do. But that's what he did. Find the right one and then buy that instead of mixing yourself. That's also why buying the index is lousy, because you get the good, the bad, and the ugly all in the same pot. Or GDX. Why would you buy GDX? Do some homework. Buy the good ones and let the other people buy those other guys that are, that have an all-in sustaining cost of $1,700 an ounce or whatever. I like the ones where it's under 1,000. That makes me sleep better. So, yeah, Anyways,
well, really good to have you once again, and we'll be checking back in with you.
Good.
And yes, I'm Charlotte McLeod with investingnews.com, and this is Don Hansen.
Thank you. Bye.